For more Fed reaction, we turn to Alan Blinder, former vice chair of the Fed and professor of economics and public affairs at Princeton. Always great to see you, sir. Alan is the author of A Monetary and Fiscal History of the United States, 1961 to 2021. So one of my favorite pieces of wisdom comes from John Wooden. Surround yourself with smart people who will argue with you. And that's what you wanted to see in the Fed minutes from Jerome Powell. Did you see that?
Only a little, and in the opposite direction that I had hoped for in my last Wall Street Journal column. I had thought there'd be a little more dovish sentiment at that meeting. Remember, that was before those annoying changes in seasonals changed the inflation profile quite dramatically. I mean, it's a wonkish point, but unfortunately it happened. Doesn't happen often, but it did happen then, which sort of tilted things more in a hawkish direction. The last FOMC meeting was before that, and I thought there might be a bit more dovish sentiment. Instead, the few, I don't want to call them dissenters because they didn't register formal dissents, but the few people, according to the minutes, that disagreed with the majority wanted 50 basis points, not 25.
So, Alan, what does that mean then for the U.S. economy, for the markets here going forward, if we have a hawkish Fed and maybe more hawkish than many had anticipated in terms of the conversations that were taking place at the last meeting?
Yeah, well, I think you've seen it already, actually, in the markets because they reacted to the data before the minutes, is a markup of the expected peak in the Fed funds rate. I've marked mine up a little. I leaned dovish, and I thought they might actually, before the recent data changes, I thought they might be thinking about stopping pretty soon. Now it doesn't look that way at all. They're not going to stop at 5.
They'll go how high? And what is the Fed to you misreading?
Well, the question is the time profile of inflation. They want to see inflation going down. It is going down. Prior to the data revisions, it was going down really fast. And that's what I reacted to and some of the dovish sentiment reacted to. After the data revisions, it's going down still, but much more slowly. And the magic number, as we all know, is 2, which on the CPI is really more like 2.5, by the way, another wonkish point. But we're not there yet. And if we go there slowly, that means rather than rapidly, that means the Fed's going to stick to its interest rate increasing policies for longer. And that's the way it now looks, mostly because of the data revisions and just a tiny bit because of the hawkish tone in the minutes. So I'm not surprised there wasn't much stock market reaction to the minutes. It wasn't that newsworthy.
Yeah, Alan, we've long been debating now for several months a hard landing versus soft landing scenario. And then we had this new term come up in terms of a no landing scenario, which has gained some traction over the last week or so. I'm curious to get your thoughts on this no landing scenario and how the Fed would potentially look at that.
Yeah, well, it's anybody's guess what's going to happen. The latter part of your question I find easier to answer. I think there's still a lot of sentiment on the Fed, not everybody, but a lot of sentiment favoring a soft landing if they can manage one, which means when push comes to shove, and we're not there yet, probably taking a little bit of a risk that inflation won't go all the way to 2 by the Fed's preferred measure. A little bit of a risk, but not a gigantic risk. Whereas the hard landing scenario would be, we're not taking any risk. We're heading down to 2 no matter what. I don't see a lot of sentiment for that on the FOMC. The no, what's come to recently be called the no landing scenario would be wonderful, like I wish for it every night. But I don't think it's very likely that we're going to get there without at least a bump of the putative aircraft.
Professor Alan Blinder, always great to see you. Appreciate all of that analysis, sir. Thanks so much.